Hi, I'm Tom Lydon, editor of ETF Trends here in Orlando, Florida at the TD Ameritrade Institutional Conference. And I'm here with Dave Mazza, head of ETF investment strategy at State Street. Dave, great seeing you. Thanks for being with us.
Tom, thanks for having me here.
Listen, this is an exciting conference. And also, I know all the great things that have been going on at State Street after a great year for the S&P 500 up 30%.
Yeah.
And you also celebrated the 20-year anniversary of the first ETF, the Spider.
Pretty
right?
exciting.
Fast 20 years, exciting,
Yeah.
right? But it's not all about the S&P 500. We're here to talk about emerging markets, and that's an area that's been beat up a little bit lately.
Yeah, it was a challenging year for emerging markets in 2013. And what's interesting is, of course, advisors have continued to globalize portfolios, right? Everyone's talking about removing the home country bias and going overseas, and in particular emerging markets, because that's where the growth is. But what happened in 2013 was clients were looking at their statements, seeing S&P 500 up 30, emerging markets much worse than that. And now we're questioning again in 2014, what do we expect from emerging markets?
It's tough for the average advisor when the S&P part of their portfolio, which tends to be the benchmark, right?
Correct.
And you have to sit down with your client and say, listen, this area has been beat up, but historically it's performed pretty well as well. So how do you actually put the arms around that and not only make the advisor comfortable with it, but how do you make your clients comfortable with the diversification to emerging markets?
That's the big thing, because over the past 10 years, where emerging markets actually outperformed developed markets by significant amounts every year, we saw the correlation between emerging markets increase to developed markets. And that makes sense, right? Because they're more globalized, they're connected to developed markets as those companies have gotten larger. But what's interesting now is we think there's a lot of opportunities for investors to think about emerging markets a little bit differently and say, do we really just want the traditional benchmarks, or take advantage of all the product proliferation in emerging markets? Because what we saw is the past few years has been a lot of launches, but there hasn't necessarily been the uptick in assets under management. And it might not take this sell-off to really be the impetus for investors to take a step back and say, how do I want to build an emerging market portfolio?
And you have to do that from a non-emotional way, number one.
Correct.
And number two, access to emerging markets through companies like yours has been incredibly easy. And you folks have developed some great ETFs to get access in a variety of ways. Correct?
Yeah, so one of the really interesting things that we think is going to be a great idea going forward would be to move to emerging market small cap companies, for example.
Yeah.
So we launched EWX, which is an ETF that gives you just exposure to those companies. And what they give you, Tom, is actually greater connectivity to domestic consumption. Because they're smaller companies, they're not as connected to the global economy. And when we think about where that growth is going to come from, particularly over the long run, as the domestic consumer, the middle class really grows, it's going to be those smaller companies.
Well, just 10 years ago, it was almost impossible for the average advisor or the average investor to get access that way. So you folks continue to find liquidity in emerging markets. The accounting principles continue to be upgraded, technology continue to be upgraded, allows you to work with the index providers and to be able to provide more product. What more do you see in the emerging markets areas you look forward?
I really think that we're seeing a sea change in emerging markets, as I alluded to a minute ago. And similar to what we're seeing in the fixed income market, where advisors are getting a lot more precise with their exposures to say, I want to have some more yield, but I want to take duration off the table. Because you have the ETFs that we and others offer, allows you to do that. So let's say you really want to get exposure to a certain region in emerging markets, like Asia Pacific, and avoid Latin America, or avoid Eastern Europe, which has a lot of those problems, of course, that we know what's going on in Turkey right now. You can do that with an ETF, like GMF that we offer. You could also you could get exposure to income from emerging markets by getting access to EDIV, an emerging market dividend ETF, for example.
Absolutely. Well, Dave, thanks for carving out a little bit of time. Really appreciate you being with us, and have a great time at the conference.
Thanks for having me, Tom.
Thank you.